Hey everyone, I'm Tim Wills and welcome back to the channel. The American IPO market has been incredibly hot this past year with a record $168 billion raised in 2020, and in year-to-date 2021 there has already been $158 billion closing in on that record-breaking figure, and we're not even halfway through the year. But despite the staggering size of the IPO market, the companies trading within it haven't been faring so well. On average, they're trading below the S&P 500 for the year, and some have even dipped below their IPO price. So what is causing all this depression in the market, and is this a sign of things to come? In the last month, at least 3 companies, Hair.com, Zenvia Inc. and Enact Holdings Incorporated, called off their IPOs. Combined, they would have raised close to $1 billion for their respective companies, but they didn't go ahead, so nothing was raised. Enact Holdings said current market pricing for the planned offering does not accurately reflect Enact's value. Basically what they're saying is the market sucks right now and they're not going to get what they think the company is worth, which is not ideal, but completely understandable. You only get one chance to IPO, and if the market's depressed or volatile, why the hell would you want to go public in that? So we've clearly hit a speed bump. These companies wouldn't just postpone their IPOs for the fun of it, because that's incredibly costly and it has a whole lot of other flow-on effects. The reason is inflation, or more to the point, the fear of inflation. So I'm going to explain why inflation and IPOs and growth stocks in general are so tightly linked. Most of the time when a company IPOs or goes public for the first time, they are in a high growth stage. They are offering up some of their company to investors in exchange for money they will use to continue to grow the company. So how do you define a growth stock? Well, there are a few main characteristics that you can look at. Number one is that it has high growth, which is pretty self-explanatory, but what that means is it's growing at a rate significantly faster than the average public company, or you can sort of look at the S&P 500 as a good estimate of that. Number 2, low or zero dividends. Growth stocks generally don't pay dividends, and this is because they want to reinvest all their earnings back into growing the company and becoming a bigger company so they can get larger earnings down the track. So those are the 2 main traits, but growth stocks often have others, like having a competitive edge, some sort of proprietary knowledge that isn't quite ready to come to market yet, and they haven't fully realized the value of it, but it will be valuable in the future. They generally have low profit margins and high risk factors. So what does that have to do with inflation? Well, we can assume that the value of any stock in the stock market is just the present value of their future earnings, or future profits more specifically. And the reason stock prices fluctuate so much is that we don't know what the future earnings are going to be, so we're trying to predict what they're going to be, and that's why the stock prices move around. And just like how $1 today is worth far less than $1 was worth 50 years ago, $1 of earnings in 50 years time is going to be worth less than $1 of earnings today. And that's because inflation eats away at your spending power over time. So if a company is in their growth stage, then they expect more of their earnings to come in the future and more of their profits to be in the future. But as inflation rises and comes up, those future earnings are worth less. So it's almost as though you're just bringing down the earnings forecasts without the company actually doing anything. So it's unfair on the company, but that's just how inflation works. So this is part of the reason why we're seeing a pullback in growth companies and growth stocks, and also why many companies aren't wanting to IPO, because companies that are about to IPO are generally in their growth stage, so their earnings, if inflation is high, their earnings are going to be worth less, and their valuation of the company is going to be worth less. So they would rather wait until the valuation comes up a little bit. But there is hope, because human sentiment has a far larger impact on the stock market than it probably should have. 2 companies are going public. Well, they've probably already gone public by the time this video comes out, to be honest. But they are Squarespace and Oatly, both big, well-known brands that should, by all accounts, do pretty well in the stock market. If they do well, it could change investor sentiment towards IPOs, opening the gates for smaller, less well-known brands to start coming back into the market. However, the opposite is also true. If the stock prices of these companies dip below their IPO prices, it could scare a lot of companies off from wanting to go public, whether that's through SPACs or IPOs, and it could make the whole situation a lot worse. The funny thing is, these 2 cycles are closely linked. What caused growth stocks to boom last year is sort of the reason why they're not going so well this year. The stimulus checks are the main culprit for that. There was way too much money pumped into the economy last year, which was this fantastic sugar hit at the time, but now we're starting to see the hangover of it, and we're only really at the beginning of the hangover at the moment. IPOs are not the only way, of course, for a company to go public. There's also a thing called a SPAC merger, or special purpose acquisition company. It's where a blank check corporation, like a shell company, takes over a private company, and then the private company takes the name of the SPAC and they get listed on the stock exchanges. It's a really quick and efficient way of going public. These aren't new, but in the last year they've become incredibly popular, but they are falling out of favor as well. This is partly due to rising inflation rates, but also because there's just a ton of SPACs out there. There's an oversupply of these blank check companies that are wanting to take private companies public. So on one hand, you have all this demand from SPACs trying to partner up with a private company and take them public, but on the other hand, there is a very limited supply of good private companies that are ready to go public and that are actually going to be a good investment, and even less now that you had that big surge in IPOs and public listings last year. So the SPACs start finding less and less ideal companies to take public, and it just gets to the point where they're just throwing shit against the wall and hoping it sticks, which is why we're seeing so many companies who go public via SPACs dip below their initial offering price, because they're just shitty companies that shouldn't really have been taken public in the first place. All that creates uncertainty, and it's just this big old cluster mess is what it is. So should you invest in IPOs given the current market situation? And the answer to that is yeah, sure, maybe. You have to believe in the company long term. It's bad enough investing in a mature company with an intention of getting short-term gains, but it's even worse if you're trying to get short-term gains out of an IPO. Warren Buffett has famously never invested in an IPO, and for good reason as well. There's just way too much hype around a company at IPO time. There's a whole combination of things. So there's marketing from the company, there's hype from media, and then there's also bankers who are getting a sales commission, so they are trying to pump the price higher and achieve a higher valuation. That just creates this environment where the valuation of the company is probably too much, and it's better just to look for a more mature company that is potentially a bargain stock. So unless you have this burning desire to own the company and you don't care that it might dip after the IPO, then sure, get into it. But otherwise, stay away from IPOs and just look for bargain stocks in the more mature stock market. And by more mature, I mean like a year after they've IPO'd at least. Which is a bloody convenient way of ending this video, telling you to avoid IPOs no matter what the market condition is. With that said, thank you so much for watching. If you like this type of content, please do consider subscribing. I post finance related videos like this every week, so I'll see you back here next time.